Hey everyone, and welcome. Over the next few minutes, we're going to dive into a popular Islamic financial tool called Sukuk al-Ijarah. And really, my goal here is simple, to arm you with a clear framework. That way you can spot a fantastic opportunity and, just as important, dodge a bad one feeling totally confident about it.
So here's our game plan. We'll start with the basics, a simple definition, then get into the nitty-gritty of the key risks you've got to know. After that, I'll hand you a practical checklist of red flags to watch for, show you how modern platforms can be a huge help, and to wrap it all up, we'll see how this plays out in a massive $50 million deal. All right, let's jump right in.
Okay, first things first. What in the world is a Sukuk al-Ijarah? Let's get on the same page and build a really simple, clear foundation. Okay, try thinking of it like this. You're essentially buying a certificate, and that certificate gives you a little piece of ownership in a real physical asset, like a building or a big piece of machinery. Then that asset gets leased out. And because you're an owner, you get your slice of the rent money. It's a pretty neat way to invest in actual tangible stuff and earn returns from how it's being used.
Now look, no investment is a perfectly smooth ride. They all have risks, and it's absolutely crucial to know what you're looking for. Think of these risks like potholes on the road, right? Knowing where they are is the absolute best way to steer clear.
So what are these big potholes we need to watch out for? Well, they tend to fall into about 7 main buckets. We're talking about everything from, is the person renting the asset going to pay their bills? All the way to, is this whole deal actually compliant with Sharia principles? Let's zoom in on a couple of the most important ones. All right, let's group the first couple of big ones together. First, you've got to ask the obvious question. Can the company or person leasing the asset actually pay the rent? That's your fundamental credit risk right there. And then what about the asset itself? The building, the equipment. Could it get damaged? Could it become outdated or just lose its value over time? That's what we call asset risk.
Then you've got the risks baked into the deal's structure itself. Is the legal contract totally ironclad? Is it genuinely Sharia compliant? And this one's huge. What happens if you need to get your money out early? Can you sell your share easily? That's liquidity risk. And trust me, it's a massive factor because it tells you how stuck your cash might be if your plans change.
Okay, so knowing the types of risks is one thing, but being able to spot them in the wild, that's a whole other ballgame. This next section is your practical pre-flight checklist. These are the big red flags you need to be looking for before you even think about putting your money in.
Let's run through a few of these because they're super important. A vague asset? That's a massive red flag. If they can't tell you exactly what you own, you should probably just walk away. Here's another one. When the special purpose vehicle, the SPV, that's the separate legal company set up just to hold the asset, isn't truly independent. Why does that matter? Well, if it's not, and the original company goes bankrupt, your investment could get dragged right down with it. And of course, weak governance. If you're not getting clear, regular reports, you're basically flying blind. Big no-no.
So, with all these potential landmines, how do you protect yourself? This is where good governance is key. And honestly, this is where a lot of modern fintech platforms are really shining, because they're designed to build that protection right in.
You can think of these fintech platforms as basically building the guardrails for you. They come with built-in Shariah Supervision, really strong governance rules, and super transparent reports. A lot of them even give you real-time monitoring of where the cash is going. All of this works to slash what's called agency risk. That's the risk that the people managing the deal aren't acting in your best interest. And what's the result? It builds the trust, the confidence that investors need to even get in the game.
All right, theory is great, but let's make this tangible. It's time to take everything we've just talked about and apply it to a real-deal, concrete example.
Okay, picture this. There's a big logistics company, and they need some cash. So they decide to do a $50 million sale and leaseback Sukuk deal. And what's the asset they're using? One of their huge warehouses.
Let's crunch the numbers here. The deal itself is for $50 million, but the asset, the warehouse, it's actually valued at $55 million. See that? That extra $5 million acts as a nice little collateral cushion for the investors. So what's the deal for investors? In exchange for their cash, they're promised a 7% annual return paid out over 3 years. And at the end of that term, the company has agreed to buy the warehouse back for the full $50 million.
So how does the money actually move around? It's pretty straightforward. First, a separate legal entity, remember the SPV, uses the investor's $50 million to buy the warehouse. Then the company immediately leases it right back and starts paying rent to the tune of $875,000 every quarter. That rent money, it gets passed directly onto the investors as their return. Then 3 years down the line, the company buys back the warehouse, and the investors get their initial investment, their principal, back. Simple as that.
But wait a minute. Here's a really critical question, and it ties directly back to those risks we were talking about. Who's on the hook for major maintenance? You know, if the roof needs replacing or there's a big structural repair needed, who pays for that? The answer to that question had better be crystal clear in the contract.
And that brings us to the next logical question, which points right back to that red flag about insurance. What if the warehouse gets damaged in, say, a fire or a flood? Who takes the financial hit? A rock-solid insurance plan has to be in place to protect the asset's value, which in turn protects your investment. Again, you've got to find the answer in the fine print. This all leads us to what is probably the single most important question you can ask about any of these deals. Is it asset-backed or is it asset-based? And the difference is night and day. With an asset-backed deal, you, the investor, have a direct legal claim on the actual warehouse if the deal goes south. But with an asset-based deal, your claim is just against the company's general credit. The warehouse is kind of just there for show. Understanding that distinction is absolutely critical to knowing how secure your money really is.
You know, at the end of the day, whether you're looking at a sukuk or any other kind of investment, it really all boils down to this. The goal isn't to find some magical, risk-free deal. Those don't exist. The goal is to understand the risks so deeply that you can manage them effectively. That knowledge, that's what turns a potential pitfall into a real opportunity.
So I'll leave you with this thought. Now that you've got this investor's toolkit, the next time you're looking at a Sukuk al-Ijarah opportunity, which one of those red flags is going to be the very first thing you check for?